Welcome back. Germany's central bank slashed its growth estimate for next year to 0.4% from 1.6%. And just yesterday, the ECB cut its growth estimates for the Eurozone. We may also see the possibility of an upcoming rate cut at the ECB. But as central bankers in Europe paint a gloomy economic picture, equity markets continue to rise. For more on this, we're joined by Alex Jashevsky. He's founder and managing partner at Recovery Partners. Alex, great to have you here today.
Thank you. Thank you so much.
I think I just kind of laid the question out there. You know, we have the ECB saying, oh yeah, we're downgrading our forecast. Europe's still in recession. We have the Bundesbank saying Germany, supposedly the strongest part of Europe, is almost in recession, basically very close, and they're downgrading their forecast. Yet, you know, European equity markets have been going up since the summer. What's happening here?
Well, on the one hand, it might seem a little counterintuitive, but on the other, you've got all this cash sloshing around in the system, and folks have to find something to do with that money. And what we know is that these QE operations express themselves through an asset channel, which is primarily stock prices of real estate. So that's really the hope here, that those asset prices rise, animal spirits rise, the economies get going again. So far, it hasn't worked anywhere, but the equity markets are still grinding higher.
But it has worked for the first part of it, the equity markets, that has worked.
Working. The first part of it's working. You know, what bang for the buck you get for spending trillions? I don't know if it's worth it, you know, from a risk-reward standpoint. I think this policy is very risky in terms of the risk-reward on, you know, how much money they're spending, how much they're stretching the central bank balance sheet, to what end? Is it really producing any real growth? No.
When we look at Europe, there was a sense as we headed into this past summer that, you know, the Eurozone could fall apart. The euro could disappear. I don't think anybody's making that bet right now. Is that about right?
Well, I think we're in a temporary lull because, you know, you had the big OMT operation that was announced, and this is supposed to ring fence all the problems. So far, it hasn't really been tested. But all those issues, the refinancing issues, the rollover profile at the various sovereigns, the fact that Greek debt is now almost 190% of GDP when it was predicted to be around 150 in the last bailout, which was only concluded less than a year ago, and they're 40% off track on the debt to GDP prediction. You know, we're still in a very, very serious situation in Europe. It's still possible that things unravel. As I say, the central bank hasn't been tested since that big announcement. Let's see what happens when it does get tested.
So, you know, we're mentioning how much those equity markets are up. I think that, you know, the DAX is up something like almost 30% this year. Are you, right now, are you long-term bearish on Europe, or do you feel mildly confident?
I'm not confident about any of this, because what we've said from the beginning is that you need to have a reckoning and write-down of all the bad debts. I was just on the phone this morning with some folks in Spain, and slowly they're starting to recognize the need to get off this trolley car of fake prices and start recognizing some of these bad debt issues and remediate them so that the economy can move forward. The reason you've got a sluggish economy in Europe is because they haven't allowed these bad debts to get flushed out of the system. They're sitting on bank balance sheets. The banks can't properly lend. They can't properly trade with each other. Corporates are nervous about counterparty risk. Animal spirits are dying. If you get those bad debts out of the system, you know, a corporate enema, so to speak, get rid of all the detritus from the last cycle, then you're going to lay the foundations for future growth. But until that happens, we're going to be stuck in this slow growth, sluggish mode with, you know, low animal spirits and no good prospects for recovery.
Now, I mentioned right at the beginning when I introduced you this speculation that the European Central Bank might be willing to actually lower interest rates to try to do a little bit to stimulate. I think there was a Bloomberg story this morning, various sources saying that it was discussed and a lot of members at the ECB would be willing to do it. Does that matter? Would that help? Would that make a difference?
Well, your base rates are at 3/4 of a point in Europe. I mean, how much lower can you go, and how much stimulus is it going to produce if you chop rates to zero? Not much in my book. I mean, if folks aren't taking out loans for projects at 3/4 of a point plus a reasonable spread, say 2 points, that means that folks don't want to borrow. You know, if you put rates to zero, so they're borrowing at 2.5 instead of 3.25, it's not going to be much of a difference. It's not going to be much of a difference. And let's not forget, the reason rates are down here is to enable sovereigns and other large debtors, primarily banks, to continue managing these debts without going bankrupt. If nominal rates were back where they were say 6-7%, all of these debt loads would become instantly unsustainable. So they're keeping them low. That's good news. If they go much lower, it's not going to produce much in the way of growth, though. It just can't.
If we get growth in the rest of the world, if the United States picture improves, if China improves, can that solve, in the long run, Europe's problem?
Well, I think those are both low probability shots. I mean, I think China's in a slowdown mode. I think they've got a debt problem there that's starting to manifest itself.
So you don't think China is bottoming and starting to turn?
No, they haven't even started to recognize the extent of the debt problem. You've got huge malinvestments in China, and that's going to impact the banks and the local authority governments there in a huge way over the next few years. It's going to take a long time to work out. By our calculation, the Chinese housing problem, the bad loan problem in the housing sector, is about 2.5 times as big as in the U.S. And in the U.S., the low rates and the stimulus from the Fed, I think, has only arrested what was a rapidly declining housing market. It's stopped the bleeding. It hasn't created the conditions for a renewal of growth and recovery.
So you don't think the U.S. housing market has now bottomed and has begun to recover?
You've got the same problem. You've got a huge shadow inventory of housing that needs to be liquidated off the defaults that occurred in 07 to 09. That shadow inventory isn't going away, and it all remains to be worked out. You've got a similar problem in the United States as in Europe, in that a large amount of the bad debts have not been remediated. They're still sitting there on bank balance sheets, and they need to be remediated before you create the conditions for renewed growth.
Very briefly, are you concerned that Europe, the United States, kind of end up like Japan, high debt, big debt?
Oh, yeah. I mean, I think all this talk about the fiscal cliff and crisis is overblown. We are in the crisis now. The U.S. is printing $85 billion a month of fake money. Europe has got this OMT program, which is backed by shaky collateral. None of this is very encouraging.
We're going to have to leave it there. That was Alex Drashevsky, founder and managing partner at Recovery Partners. And if you missed any of today's program, you can always watch it online at bnn.ca.